Greetings and happy Tuesday to you. On our last podcast, we introduced the second of our 7 money milestones, which are the key steps that will help you achieve financial security, become financially independent, and pursue wealth by overcoming debt, protecting and prioritizing income, developing a savings, growing cash, and guarding your financial legacy. If you recall, we discussed proper protection of your income and assets using life insurance. Because this particular step covers a lot of information, if you recall, we broke the session into 2 parts to make it easier to understand and not so complicated. Recapping, we introduced the concept of temporary insurance or term life insurance, which provides protection for a specified period of time, like 10, 20, or 30 years. You have the insurance coverage for a term, which is why it's called term life insurance. It is the most affordable or cheapest life insurance available because it provides only one core feature, a death benefit, and because it expires after the term. With term life insurance, it's possible to secure a substantial amount of financial protection for your family or business with a relatively small monthly payment. Today, we will discuss the second of this 2-part milestone called permanent or whole life insurance. So if you're ready, let's talk Tuesday. Like term, permanent insurance provides a death benefit to protect your family financially. However, it is designed to be kept for life, not just for a term. It also offers more benefits, which is why it costs more. Think of permanent life insurance as a lifelong strategy that can protect your family today, secure your wealth in the future, and provide for your heirs long after you're gone. The benefits of permanent life insurance are: you get life insurance coverage for life. As long as you don't let your policy expire or lapse, you will never lose your insurance due to illness or health problems. You can add long-term care protection as an optional rider. Long-term care protection can cover the cost of services you may need one day, like in-home care or a nursing home. You can add long-term care protection for an extra cost by coupling it with your permanent life insurance policy. And we'll discuss more on that a little later. You also have the flexibility with your premium. After you've accumulated cash value in your policy, it can be used to cover the cost of your insurance if you can't pay your monthly premiums for a while. This flexibility can help prevent the lapse of coverage. Now, what can cash value do for you? If you are like many people, you're not just unfamiliar with the concept of cash value. In fact, you may never even heard of it. But cash value is by far the most pivotal benefit of permanent life insurance after the death benefit. It's simple and powerful. Here's how it works. A portion of your monthly premium is set aside in an account that grows over the life of your policy. Some pay you a guaranteed interest rate, while others offer growth tied to a variety of investment markets. Either way, you are activating a benefit of your life insurance that leverages the power of compound interest. Remember that term? Now, cash value can be used to fund purchases like a new car, a vacation, or even a wedding. But at some point, often around age 65 or 70, you can throw the switch, if you will, on your policy. And what that means is at that time, you can start taking out tax-free income for retirement as long as the policy value is sufficient. So let's talk about the advantages of cash value. Cash value has tax-free growth. That means you never pay tax on the growth of your money as it compounds over the life of the policy. You also have a zero market risk. Normally, money tied to the market is exposed to both gains and losses. However, some permanent life insurance policies make it possible to take advantage of the gains tied to the market while completely avoiding losses. Also, it is creditor-free. In most states, the cash value associated with a permanent life insurance policy can't be touched by creditors. And then finally, it has tax-free income. When you decide to take money out of your policy to use it as income or to make purchases, you never pay tax on it as long as the policy is active. Now, earlier we touched on long-term care, or some people refer to it as LTC. So let's spend a little time discussing what long-term care is. So long-term care insurance covers out-of-pocket expenses for qualified long-term care services, including nursing home care, home health care, assisted living care, and adult daycare. Now, there is a misnomer that is associated with long-term care, and that misnomer is that it's generally used for older people, and that is not true. In fact, anyone at any age could qualify for long-term care. And currently, 37% of people receiving LTC benefits are under the age of 65. Because you never know at what point you might need long-term care, consider securing a long-term care insurance policy when you're younger and healthier, and when it is most affordable and easiest to qualify for. The average long-term care need is more than 1 year. It's 3.9 years. And how you recover from bills that can pile up into hundreds of thousands of dollars, that's one of the things you need to consider. And that is the purpose of why long-term care insurance exists. Now, when it comes to purchasing long-term care insurance, there are two options that you can choose from. Option one, purchase a long-term care insurance as a traditional stand-alone policy. Now, even if you don't have life insurance, you can go directly to a life insurance company and purchase a standalone long-term care insurance policy with this option. While it stands alone, long-term care insurance policies start off with a low premium, but often insurance companies raise the rates on existing LTC policies. Now, with many policies, you pay out of pocket for care, then get reimbursed after submitting receipts. And there's also a 90-day waiting period for benefits that most long-term care policies require, and it can be customized for a standalone policy by paying a higher or lower premium to maybe shorten that 90-day window. And then, since there is a 70% chance that you will need long-term care, there is also a 30% chance that you won't, which means you can spend thousands of dollars on an insurance premium of long-term care and not get anything back in return. Now, mind you, that is with a long-term care stand-alone policy. Your option two is adding a long-term care protection as a rider on your permanent life insurance. Now, here's the difference. If you're planning to get permanent life insurance, you can add long-term care protection to the policy in the form of a rider for an extra cost with the following options. Unlike the standalone long-term care policy, life insurance companies typically will not raise your rate for policyholders. And some insurance companies pay you money to cover your long-term care expenses after the waiting period, which you can spend it as you see fit. No need to submit receipts once the eligibility requirements have been met. Also, you can get significant savings by joining your life insurance with your long-term care protection. And if you are one of the lucky of the 30% who won't need the long-term care protection or the long-term care insurance, your premiums that you would have paid will not be wasted. Instead, your family will receive a tax-free death benefit. Now, there are two other living benefit riders to consider as well. Besides long-term care insurance, there are other living benefit riders to consider adding to your permanent life insurance policy. Some are quite affordable or cost nothing extra at all. And here are those two popular living benefits to consider. The first is critical illness. This rider enables the insured who is diagnosed with a critical illness like a heart attack, stroke, or cancer to collect a portion of their death benefit to cover their expenses. The second is chronic illness. If the insured is diagnosed with a chronic illness like ALS or Alzheimer's disease, arthritis, or even diabetes, this rider enables the insured to access a portion of their death benefit as well. I would encourage you to have a conversation with your financial advisor if you have one. And if you are in need of a financial advisor, I could recommend one of our How Money Works financial advisors for a free consultation. Just contact us by phone at 937-889-9809 or by email at theacademyoffinancialliteracy@gmail.com, and follow us on Instagram, Facebook, and LinkedIn. On our next podcast, I will introduce you to creating an emergency fund, which is the third step of our 7 money milestones, your roadmap to financial security and financial independence. Until then, have a good day, and let's talk Tuesday.